Here's a question that determines whether a business thrives or dies. Where does the money come from? Because money isn't just money. A loan from a bank is different from an investor's capital. Reinvested profit is different from a line of credit. And the source of your finance quietly controls your risk, your flexibility, and your future. Most entrepreneurs don't realize this until it's too late. By the end of this video, you will understand finance as structure, not just cash. Let's dive in. Before we classify types of finance, let me explain why this matters. Okay, imagine two businesses both raising 1 crore rupees. Business A gets it from bank loan at 12% interest. Business B gets it from investors in exchange of 20% of equity. Same amount of money, completely different implications. Business A has to pay 12 lakh rupees every year in interest, whether they are profitable or not. If revenue drops, they still owe that money. That's a pressure, that's a risk. Business B doesn't owe anything monthly, but they have given up 20% of ownership forever. If the business becomes worth 100 crore rupees, they have just given away 20 crores. See the difference? The source of finance determines your obligation, your control, and your risk profile. That's why classifying finance isn't just academic, it's strategic. Now let's break down the types. First classification is simple. Internal finance versus external finance. Internal finance is the money that businesses generates from within the business. External finance is the money that business raises from outside. Let's start with internal finance, retained earnings. This is the profit that business has earned and kept instead of distributing to owners. It's the cleanest form of finance. No interest, no dilution, and no external obligations. You earn it, you reinvest it, you own it. This is how most small businesses grow slowly, steadily, reinvesting profits. It's safe, it's sustainable, but it's also slow. If you can reinvest only 10 lakh rupees a year, you can't suddenly scale up to 10 crore rupees. That's the limitation. Now let's talk about another type of internal finance, that's asset sales. Sometimes businesses sell assets they don't need to raise cash. An unused property, old machinery, a non-core division. This generates internal cash without borrowing or dilution. But it's a one-time move. You can't keep selling assets forever. External finance, the outside world. When internal cash isn't enough, business goes external. This is where things get interesting. External finance comes in two broad forms: debt and equity. Debt means borrowing money that you will pay back with interest. Equity means selling ownership in exchange of capital. Each has trade-offs. Debt keeps control in your hand but adds fixed obligation. Equity removes fixed obligation but dilutes ownership. And businesses constantly balance these two forces. We'll dive deeper into debt versus equity in future videos, but for now just understand internal finance is limited but safe. External finance is powerful but comes with strings attached. Now let's classify finance by time horizon. Because money needed for 3 months is very different from money needed for 10 years. So first let's talk about short-term finance, which is less than 1 year. This is the money used to manage day-to-day operations, paying salaries, buying inventory, covering short-term cash gaps. Trade credit. This is when suppliers lets you buy now and pay later. You get inventory today, you pay in 30, 60 or 90 days. This is free short-term finance and most businesses heavily rely on it. Second, bank overdraft. This is when your bank lets you withdraw more money than you have in your account. You overdrew, you pay interest only on the overdrawn amount. You repay when the cash comes in. It's flexible, it's fast, but expensive. Short-term loans. These are the loans for a few months to a year, used for immediate needs like buying stock, covering payrolls, or handling seasonal demand. Usually have higher interest rate because they are riskier for lenders. Why use short-term finance? Because you don't want to lock yourself into long-term debt for temporary needs. If you need 5 lakh rupees for 2 months, taking a 5-year loan makes no sense. You'd pay years of interest for something you only need briefly. Short-term finance matches temporary needs with temporary fundings. So now let's talk about long-term finance, more than 5 to 10 years. This is the money used for big structural investment. Buying land, buying factories, acquiring companies, launching new product lines. The most common forms of long-term finance are 1. Equity capital. Money from owners or investors in exchange for ownership. No repayment required, no interest, but you give up control and future profits. 2. Long-term loans. Money borrowed from banks or financial institutions, repaid over 5 to 10 years or even 20 years. Lower interest rate than short-term debt because the lender has more certainty. But you have locked in, you owe money for years. 3rd. Bonds or debentures. Large companies issue bonds to raise money from the public or institutional investors. Bonds are like loans that many people give you and you repay with interest over time. Okay, so why use long-term finance? because big investments takes years to pay off. If you build a factory, it won't be generating profit immediately. You need finance that gives you time to build and scale and earn. Here's the key insight. Matching the duration of finance to the duration of assets is critical. If you use short-term money for long-term assets, you will face constant refinancing pressure. If you use long-term money for short-term needs, you will pay unnecessary interest. Smart businesses match financing duration to asset duration. Now let's go deeper into the two fundamental types of external finance: equity and debt. They are not just categories, they represent two different philosophies of financing. Equity finance, sharing ownership. When you raise equity, you are selling a piece of your business. Investors give you money. In return, they own a percentage of the company. Advantage of equity: no repayment obligation. If the business fails, you don't owe anything. No fixed interest, you are not bleeding cash every month. Investors often bring expertise, networks, and credibility, not just money. Disadvantages of equity: you lose control. Investors has a say in decisions. You dilute your ownership. If the business becomes huge, you are given away a fortune. Equity is expensive long term. Investors expect high returns, often higher than loan interest. Debt financing, borrowing money. When you take debt, you are borrowing money that you will repay with interest. The lender doesn't own the business, they just want their money back with a return. Advantages of debt: you keep full ownership, no dilution. Interest is tax deductible, it reduces your taxable profit. Once the loan is repaid, the relationship ends, the lender has no future claims. Disadvantages of debt: fixed obligation, you owe money whether you are profitable or not. Risk of bankruptcy: if you can't repay lenders, they can seize your assets and shut you down. Limited flexibility, high debt makes it hard to take risky or pivot. Here's the mental model. Equity is sharing risk, that is taking risk alone. With equity, if you fail, investors lose too. With debt, if you fail, you lose everything, and lenders still want their money. That's why startups with uncertain future profits prefer equity, and mature businesses with stable cash flow prefer debt. Now, let me introduce something more advanced. Not all finance is purely equity or purely debt. There are hybrid instruments that combine features of both. Convertible debt: this starts as a loan, but under certain conditions it converts into equity. Startups use this to delay valuation decisions while still raising money. Preference shares: these are shares that gives investors priority during profit distribution or liquidation. They are like equity but with same debt-like protections. Mesian finance: this is a mix of debt and equity, often used in buyouts or large expansions. It's riskier than pure debt but less dilutive than pure equity. Why do hybrid exist? Because businesses and investors negotiate. Sometimes pure equity is too expensive, sometimes pure debt is too risky. Hybrid creates middle ground. You don't need to master hybrid yet, but know they exist, because once you scale up, you encounter them. So how do you choose which type of finance to use? Here's a simple decision framework. Ask the question: is this need temporary or permanent? Temporary, short-term finance. If permanent, long-term finance. Ask question: can I afford fixed obligation? If yes, that is fine, you keep control. If no, equity is safer, you share risk. Ask question: how much control do I want to keep? Full control, debt. Willing to share, then equity. Ask question: what's my risk tolerance? High risk, debt. Cheaper long term if you succeed. The best businesses use a mix. They don't rely purely on debt or purely on equity. They blend internal finance, external finance, short term, long term, equity, and debt based on context. That's called capital structure optimization. And we'll cover that in the future videos. So that's the landscape of business finance: internal versus external, short term versus long term, equity versus debt. Money isn't just money, it's structure, risk, and strategy. In the next video, we'll talk about the time value of money, the single most important concept in all the finance. Hit like if this was helpful, subscribe to keep building your financial fluency. See you in the next one.